Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Sorry I am super late. I had a really hard time finding food this morning, but it's okay. We're here to go. Wednesday, big day because NVIDIA earnings today, and I'm really concerned that this could be like the turning point for the market. Even if they do well, I think that people will sell off. We're in a seasonally weak time of the year. There's a lot of other things related to flows that kind of suggest that the next few weeks will be to the downside. Let's go to the charts and see where we are at this morning. So here in ZN, it was a pretty tight day yesterday, and the overnight pretty nonchalant as well. Oh, maybe like a tick or two higher though, yeah? And here's the S&P 500. They took a little bit of a tumble yesterday early on. They recovered most of it by the close, but now here today in the overnight session, we're down. And like I said, a lot of seasonals and other kind of flows are coinciding with each other to make the next few weeks likely to be down. Coming over into oil, we've got a little bit of a decline overnight. So, maybe global weakness. I don't know. There's still a lot of like geopolitical tensions, stuff with the Red Sea, that sort of stuff going on. But oil seems to be taking it in stride, and it hasn't been affecting them too hard. But here you can see gold and silver still okay. At least still up. Every time I come in here, I expect to see some sort of a dip, but they keep staying up there. Copper's doing good. Oh, that's actually looking really good now in copper. They got a ways to go, but that's looking really good in copper. And the dollar/Japanese yen, you can see that the dollar took a bit of a tumble yesterday, and now here in the overnight, briefly above 104, but not able to hold it. And then Bitcoin, well, so it's kind of hard to see because we're so far out, but when you look at Bitcoin, they took a tumble with the rest of the risk assets, but then they recovered it, and then they lost it all again. So there is like some real back and forth going on. And Bitcoin, I suspect that some of this was a bit of a pump. Tether purchases and whatnot, specifically timed to try and keep the market up, but it didn't seem to hold it. So that is very curious to me. Some things going on in Bitcoin. So that's where we're at this morning. It is still a relatively quiet day in terms of news, but we do have a 20-year auction today. So that's going to be some supply coming into the market. May push the treasuries down a little bit this morning. We'll see. Going to be watching that ZB. That's where we might see a lot of hedging go on. I knew the 5,000 lot at 111 ZN was a spoof. Went to the 7,000, the level below. There's some trading on Sear chart. So, oh man, they give you a 10-minute delay. They don't have a sim account, so you can just trade against live data. There's got to be a way to do that in Sear charts. There's got to be a way to do that. Well, where are you talking about? Way up here? I don't know. I don't see any big orders up there right now. Liquidity is looking pretty good these days, though. We're getting 4,000s up on there. That's like the traditional liquidity. That's what it used to be. This is what I'm used to. It took like 2 or 3 years, but we got back to normal. back to normal. Well, oh, 110. Was there a, did somebody put a spoof up at 110? Well, so let me tell you, oh man, I wish you had a real name. Mr. Weirdo Face. I don't know what kind of a face is that supposed to be. You look like one of those creatures from Made in Abyss. Is what you is what that looks like. If you've ever seen that anime. So round numbers tend to have more liquidity at them. Barkin is speaking right now, by the way. He's saying we got a lot ways to go before we achieve a soft landing, is what they say. Anyways, the rounder the number, the more liquidity you're going to see there. So in treasuries, well, if I go over into the indexes, it's pretty easy for me to describe what is a round number. 4970, pretty round number. 4975, pretty round number, but not as round as 4970, and definitely not as round as 4900, and that's not as round as 5000. Like, people just have a tendency to gravitate towards multiples of fives, tens, hundreds, thousands, right? But what is that in the treasuries? Well, in the treasuries, there's 110 even. That's the clearest one, right? But then you can divide the handle up by quarters. So 08, 16. There's usually something weird going on at 16. You see how right there, 110, 16? And look, there's more liquidity at 16 than there is anywhere else, right? And then 24 would be the other one, okay? Those are really round numbers. So when I see large orders at those round numbers, I kind of discount them. They're not very likely to tell you a whole lot about where we're going next or anything like that. They're also less likely to be spoofs. So if they put a 5,000 lot at 110 and then it completely pulled, that is actually a little bit unusual. But another thing I will tell you, something that can happen is people can misinterpret the pulling, okay? And I only know this one because I worked for a bank. But here's how this works is at the bank, they'll go and they'll put an order on. And then they can right click on it. And you'll get a window like this, right? Except for that their window says refreshing order. And then there's a box to say how much of the refreshing order to show and yada, yada, yada. So sometimes what will happen is they'll put an order on there and then they say, hey, I'm not so sure that that's going to get hit. I don't really want to be showing that liquidity anymore. Let's modify it and turn it into a refreshing order. And so what you'll see when that happens is we'll come to that price, the order will pull, but then you'll still actually see 5,000 contracts trade there. So always, if there's a price and you see pulling, still pay attention to how much traded there. It's when you get there and it seems like it's a key level and there's a big order there and it pulls and then you trade through it and only less than 1,000 contracts trade to go through it. That's when it's like, oh, hold up. There's also a couple of things I talk about if you've watched my order flow video where I talk about stacking, pulling, and large orders. I would pay more attention to the large orders at the beginning of the session rather than the end of the session. At the beginning of the session, it's more likely, like the big traders are going to do something, they do stuff early. So those orders at the beginning are more likely to actually be something, whereas later on, there's kind of manipulation. So we got a 20-year auction today. So, a 30-year is kind of more of a better hedge. But you're probably going to see hedges in the 30-year and the 10-year. And a 5,000 contract buy at 110 makes perfect sense to me. Let's see here. Haven't proof checked yet, off topic, but we can now use human urine and acetic acid to recover most of the cobalt from lithium bats. I've never heard of that. That's interesting. And by the way, good morning, Anna Stefa. Just because you can iceberg it, it might not mean you want to use an iceberg every single time or trade. Other things go on too sometimes, yeah. Well, and you think about the kind of person that's using an iceberg, right? Icebergs are significantly more likely to be a hedger. So what that means is that his opinion about, it's a buy or a sell does not have a whole lot of predictive power about where things are going, right? He's not predicting that it's going to go up or down. He's just hedging. Now, if you're coming in and you're expecting there's an auction today and they're going to all hedge in a certain direction, then now you got something, right? And then you come in and you start seeing all of the icebergs and are all in the same direction. Now you got to trade, right? So it's kind of hard. Usually for a auction, we kind of sell and then we buy after the auction. So I think I'm not seeing enough activity here in the first 15 minutes to warrant to trade. But I have kind of been stalking a short. I would say it's already too late. Like I've already seen enough that I don't think that there's a really good trade in it for me. I've already, because I'll come in and I'll say, here's my bias. And then do I see order flow coinciding with that? So my bias is a sell for hedging the 20-year auction. I'm not seeing flow coincident with that. Now, maybe those guys are going to wait. Maybe they're not going to come in until like the 9 Eastern time, 9 to 9:30 Eastern time before the market opens to come in and do something. But for right now, they're not really giving me a whole lot to work with. Saw the initial release on the cobalt recovery from lithium batteries. Cobalt is rare and hard to get, so recovery is great for humanity, especially if we can use T. But, that just reminds me of one of the stocks that I own, Rare Earth Resources, REEMF. Their whole thing is that they are building a facility that has new methods of extracting the rare earth minerals chemically from the material. And they got certain grants and money and everything, and they're currently building out the facility right now. I tell you what, everything that I read right now coming from the stock market world is about NVIDIA earnings today. They're pricing in an implied move of like 10% on NVIDIA. Like if they don't meet expectations, it's going to be a real bender. I kind of wonder though, if it does end up being good, and you get the knee-jerk reaction higher, and then they sell it anyways. I also kind of suspect that could happen with NVIDIA earnings tonight. It is tonight, right? Yeah. So I ran into a conversation on Reddit where they were talking about the inflation subreddit. And I made the assertion that it's a political sub. I posted a research study that came from a conservative think tank talking about inflation that contradicted the prevailing sentiment on the inflation sub, which is that inflation is caused by corporate greed. And they banned me. Like at first it was okay and it was fine, but then when I went into the comments and, they had kind of like arguments against the article, and I destroyed those arguments. And after that, they banned me and deleted the post. So these people are like, oh, it's a Trumper sub. No, it is not. It is absolutely not. Yeah, this is on Reddit. I mean, the incident that I'm talking about was a couple of weeks ago. We talked about it when it happened, right? But now there's this person saying that the inflation sub is a Trumper sub. It's not. I'm pretty certain that it is a left-leaning sub. Like a Trumper sub doesn't have problem with a Republican think tank research study being published. But, I thought, well, it's not that I thought anything. I think that when I'm on Reddit, I see something and I have a thought and I just post it. A lot of the time I think about like, well, what kind of an argument is this going to spur? And do I really want to argue with people about it? And then I don't post it. But yeah, if you don't recite your lines correctly, you get disappeared. It's pretty crazy to me that it's a subreddit about inflation. I posted a research study about inflation, one that was getting the rounds on all of the economic blogs and things like that. And I got banned for posting that. And then you're telling me that there's not an ideological basis behind that? Like, that's just absolutely ridiculous. Because if it's like, well, this article doesn't necessarily follow our rules. Okay, well, so first of all, they didn't have any rules against it. But if they were saying that, then you just say, hey, that's against the rules. We're going to delete this. We reprimand you. You don't ban them right away, right? You only ban somebody right away if you are concerned about what they're going to post in the future and that you don't like what they're going to post in the future. And if you're a neutral sub, then the only thing that they could be posting in the future that would be bad would be spam, right? But that's for somebody to call it a Trumper sub. No, it's not. It's not. I can tell you it's not. But the thing that I think the thing that's kind of funny about it is that the subreddit that this conversation came up in is r/Austrian economics. And I am not a fan of Austrian economics. See, the word economics is too broad. Because on one vein, economics is like the empirical study of the economy. But on the other hand, economics is also the philosophical study of economics, right? And Austrian economics assertion is basically that the entire foundation of Keynesian empirical economics is bogus, which is nonsense. They've got some really good data. A lot of their models have proven themselves to be very effective. So in my mind, when I think economics, like economics is empirical science, Austrian economics is not actually economics, but it is economics because it's philosophical for the most part. So it's funny. I didn't join the subreddit, but it's funny that Reddit's starting to show me that and baiting me into arguments with people there. But I didn't really want to make an argument there. Somebody posted something about the inflation subreddit, and I, made a comment just to, what do you say? Back up what they were saying. There's another subreddit called like Reddit censorship or something like that. That's the one where it's wild, right? Like the most censored subreddits on Reddit are white people Twitter and black people Twitter. If you say anything that isn't in line with the political narrative, you're disappeared. Yep. Okay, unrelated, but wasn't the way inflation is calculated changed, or am I tripping again? You're correct. So this is a big argument, and it really irks me. So, sometime in the late 80s, they did change, generally speaking, the way that they calculate the inflation metric. And so something that you'll see a lot of people, particularly right-wing people, say is, this isn't the real inflation rate. They changed the way that inflation is calculated to, misrepresent how inflation is actually thing. And if you go and you use the old metrics, then inflation is like twice as high, right? Well, the thing is, they changed the way that it was calculated for very good reason. Okay, it wasn't just to make politicians look better. They changed the way it was calculated for a very good reason. And the new calculation is better, in my opinion. But you'll never hear these guys say that. They'll just say, it changed. That must mean there's something you don't want to know. They don't want you to know. They don't really ever go into the specifics of it. Although I'm not sure I'm really prepared to go into the specifics of it right now. If you'd asked me a couple of months ago, I would be able to tell you the exact specifics of it. But I would have to go and read it back up again to tell you exactly what changed. Because it's like pretty esoteric stuff, right? Meaning, only economic nerds really know about this and talk about this sort of a thing. For Make It Bring, you're slow to learn? Well, I keep posting on Reddit. I don't know if that means that I'm slow to learn. Despite being censored and all of those sorts of things, I still enjoy posting for whatever reason. And maybe at this point, I just enjoy reading or posting because of habit. I don't know. Now, I don't have any opinions. It's just something I remembered. And well, yeah, but it very much colors the conversation around inflation, right? But the other thing that colors the conversation around inflation is that the Federal Reserve targets a 2% per year inflation rate. And conservatives generally don't like that. Conservatives would prefer that we have a gold standard where your money doesn't decline in value ever. But just look at the way that the economy has grown from basically the Nixon administration when we kind of switched from gold, and before that, right? Once we moved to the financial system that we have today, that allowed us to create large corporations and global growth and have super high growth rates and things like that. Up until the 2008 crisis, and then the liberalization of financial regulation kind of put a cap on growth. Since then. I digress. So here's the thing. I still have some food. So I had a hard time finding food, and I was only able to get halfway through it before I was like, I really need to go and start the stream. So I'll give you guys a few minutes to ask some more questions, and I'm going to take a few bites here. In fact, I'll turn the camera off because you don't want to watch me eat. Okay? What makes you size up past normal? Conviction. Yeah. I would put it as conviction. To be honest with you, that's kind of a part that I don't really feel like I have figured out. Like, I don't really have really good data to tell you, like, it makes sense to size up in these situations and size down in these sorts of situations, other than like how you're performing and whatnot. I muted myself. I'm sorry. Yeah, so are there any interesting papers about bonds? So I don't have like names of papers, but the first one is I would read about the Vasiak model, or is it Vasicek? I forget how you say this guy's name, but basically it's a model for pricing bonds that has been pretty revolutionary in terms of like pricing things. Yeah, see, I don't know if it's Vasicek or Vasicek or how you're supposed to say that. But that's a pretty big one to read in bonds. I would also, search for like time series momentum in treasuries, because I've seen, a bunch of papers kind of suggesting that the momentum effects in the bond markets are very strong, which is kind of counterintuitive. I think that a lot of people would think that momentum wouldn't work in the bond market very well. Have you read Trades, Quotes, and Prices? Yes. Come on, you've been here before. We've talked about that. We talk about that book every day. Are you trolling me, Paul? Oh, that was to Funny Face, yeah. Sorry, bro, but your name is Funny Face now. If you want to day trade, I highly recommend reading Trades, Quotes, and Prices, Financial Markets Under the Microscope by Jean-Philippe Pouchot, Julius Bonnard, Jonathan Donnier, and Martin Gould. And it might make you want to not trade, but this book is essentially everything we currently know academically about market microstructure. So it basically summarizes like 30 years of empirical research. You read this book, and you then have the context to go out and read studies in the market microstructure section of quant finance. I haven't been there this month. I guess it's probably a good time to go and check. So I'm talking about archive.org, arxiv.org. See, the X is supposed to be a chai. That's why it's archive. Gonna buy Mark Douglas? Nah. Then you get this trading and market microstructure section. You can go to current. It's not that, Mark Douglas isn't bad, but I think that the people that he is talking to are not day traders. Learning the market, sentiment-based ensemble trading agents. See, so this is classic market microstructure stuff. Perpetual futures contract in centralized and decentralized exchanges. So that can tell us something about perpetual future contracts, which we don't trade. But then in centralized and decentralized exchanges, could maybe tell us something about that. Starting to get a lot of machine learning sort of studies. I don't see anything super, super interesting to me in here today, but you go and you read these, a lot of the time it's going to be like, what the heck are they talking about? But if you're familiar with the studies that came before it and the studies that are like the big quintessential studies in the field, then you have the context, and what they're talking about makes a lot more sense. I think I have this microphone too high, actually. Should have it like that. Talking down into it, and it's not in my line of vision. There we go, like that. And you still hear me fine that way, yeah. Maybe just a little too much. Does the estimated Q position in Jigsaw differ from a sim trade versus a live trade? I think what you were gonna say. It is. So the default setting in Jigsaw is a little tight. I think there's actually, let's see here, where is it? you can change it somewhere. I don't know if it changes the way the sim works or not. Well, I don't know where this setting is, but there is a setting somewhere to about you know, what percentage of them go through. Maybe it's an appearance. I found a little variation in their two forms here. Man, yeah, where is it? Somebody was talking about there's, you know, the estimate for where you are in the queue in Jigsaw. And I was noting that there is a setting somewhere in Jigsaw that lets you change the estimate, but I don't know where it is. Configuration options, autosave, market depth throttle, use local logger, smart queue, bridge port, chart scale, enable GPU chart. I swear it's in there somewhere, man. Huh, I don't know. Maybe I'm just maybe I'm crazy. Maybe I'm remembering something that doesn't actually exist. Well, I came in saying, you know, I think that because of the 20-year auction that we might see some softness today, but I don't really see that at the moment. It's been awfully tight though, hasn't it? The most I've learned for sitting in front of the Dom for hours and staring dead serious, felt lost before that. Now I think the Dom is truly the best way to trade. I'll look at TA with contempt. Well, I find that really curious because, like, what would you define as technical analysis? I find that technical analysis is way less defined than people realize. So, like, the great example that I give, or the one that I think is the most interesting to discuss, rather, are momentum strategies technical analysis. So for a momentum strategy, you could be doing something like if a commodity is breaking a new 50-day high and the 100-day moving average is above the 200-day moving average or something like that, then I enter in on it, right? So isn't that kind of technical analysis? Well, so first of all, it's not really saying that we're more likely to go up than we are to go down. What it is, all that setup is trying to do is trying to pick the beginning of a trend. So basically what you do is anytime that the beginning of a trend could possibly be starting, I'm getting in. It's not actually a prediction that there will be a trend. And most of the time there's not. And so the win rate for these strategies are like 25%, right? But if you do catch a trend, you catch the whole thing. So that is to say, you're not using past data to predict future data per se. Okay, but I think most people would still think of it as technical analysis. But then the other part of it is that you have a universe of assets. You have like 100 different instruments that you can potentially trade in, and you're watching all of them. And there's all of this analysis that is done about the correlations between them to determine, to make a portfolio that is highly uncorrelated and so forth. That's a really big part of the magic of those kinds of strategies, right? So it's not technical analysis the way that most retail traders think about technical analysis. One could say you are doing a strategy that relies almost purely off of the price of different instruments, right? So from that perspective, you could consider it technical analysis. And I think that kind of from my kind of view of technical analysis, which would be using price. I always said using price to predict future price. Let's just modify that a little bit to say using price as part of some sort of systematic strategy. And that only incorporates that. It's kind of like, that's technical analysis, right? So depending on how you look at it, you could say, well, yes, technical analysis does work. But it also, I would argue that it still doesn't, because it's kind of like, no, what works is momentum strategies. You might say that a momentum strategy is a form of technical analysis, okay? But what really works is momentum strategies, and it tells you nothing about the rest of technical analysis, right? And that's kind of my take on it. Momentum strategies work. Whether it's technical analysis or not is up to your definition of technical analysis. But if you believe that it is technical analysis, then that is one technical analysis strategy that works, but it says absolutely nothing about the rest of the field of technical analysis, right? Okay. So what does that have to do with order flow? Well, again, depending on how you define technical analysis, kind of depends on whether you think what you're doing is technical analysis or not. Because again, I said price, but you can do the same kind of analysis using order flow data. So in my opinion, order flow is basically the data. Order flow is basically data informed by the level 2, the depth of market. So once you have the depth of market involved, you can do things like sign the market orders, whether those market orders are market buys or market sells. You can look at the stacking and pulling, all of these sorts of things. That ends up being quote unquote order flow, right? Well, you can totally do what I would call a technical analysis on order flow, where there's some pattern that you're looking for in the stacking and pulling that you think gives you a good trade and will move things up or down, right? I don't think that, like, so catching the edge is like, there's like less than 1,000 contracts on the bid or the offer, and you hit into it just as it leaves that price. You know, there's very few on bid or offer, and you take out those orders and then it ticks, right? I wouldn't consider that the same thing. That's a market microstructural sort of a thing. But any sort of, like, you see some sort of pattern and you think that means it's going to go up or down, that to me is applying technical analysis to order flow. And my thing is, it's not even necessarily like technical analysis so much. I rail against technical analysis because to me, technical analysis is the kind of quantitative strategies that retail traders share, and none of those work, right? But it's really more that trying to use the past data to predict the future data on an intraday time period is just kind of a fool's game, in my opinion. Like that's my take on it. I think that the things that are out there that will cause any individual asset to buy or sell. Oh, interesting. There's an iceberg there. Do I want to have? The number of things that can be happening that might cause an asset to go up or down, right? There's so many of them that, and any individual one of those things could negate any sort of, what you saw in the past, right? If I come in and I buy 100,000 contracts, okay, I'm not going to give any sign, right? I'm not going to tell anybody. The market has no clue that, because I just decided to do it randomly, right? When I start buying, the market is going to move up, and it doesn't matter what it had done before, right? And the issue is that you think that, like, that's an extreme example, but it actually turns out that pretty much any, reasonably large player, and there are literally hundreds of them, any one of these coming into the market could move the market. That's the whole thing. Is that the market is very inelastic. That's the thing that retail traders don't understand. That's the primary misconception that trips retail traders up, is the belief that it is extremely difficult to move the market, and that the market doesn't move unless, like, everybody's moving together, sort of a thing. It's not true. Any one individual person can move the market, and pretty much every non-retail trader moves the market to some degree, right? And that creates a chaotic system. So in a chaotic system, paying attention to any one of those at random is a fool's errand. It's kind of like standing in a crowd and saying, oh, I heard this one thing in the crowd. I don't know who said it or who that was or anything like that, but I'm going to follow that person. That's essentially what you're doing. But it's a whole crowd of people. Most of those people are uninformed and don't know what's going to happen. The only way that you have any kind of efficacy is if there's this one guy and he knows what's going to happen, and then he says something, right? But we can't see that in the market. All of the orders are anonymous. That's why what I do is I use that more as a confirming factor, right? I think I know what's going to happen. And then there's still risks involved in doing that. So I'm going to wait and watch the order flow to see if there's some signs that kind of coincide, that kind of prove me correct. And then that allows me to get in, and it allows me to get in faster. Right? I knew the definition of TA is, I only want to hate on ICT. Well, there you go. Cool. Now I feel like it was a new person comes in. They want to talk about why ICT and smart money concepts is nonsense. And I'm like, are you trying to bait me? I'm highly suspicious now. This is just too convenient. Well, now smart money concepts is a different issue entirely, because first of all, the guy that kind of claims to have invented all of this stuff is just crazy. It really is just a kook. But then on top of that, pretty much everything that they say about the market is empirically false. Pretty much everything that they say about the way that this works is empirically false. The biggest one to me is that they say that, like, there's an algorithm, and if you know the algorithm, that no, there's not. Okay, this is a combination of literally thousands of algorithms interacting with each other, and the algorithms that are participating is constantly changing as people come into the market and come out of the market and lose, right? And these big players that want to manipulate things, every move will move the market, yes, but that means that your entry will move the market and your exit will move the market. And there's this devious thing where if you have a big move up, and then if you buy it up really strongly and then you immediately sell, because you kind of leave this liquidity vacuum behind it, this sell will have more impact. The second meta order will have more impact. Interesting. So 0.5 was where we saw an iceberg before. They just bought 3,500, and that was pretty aggressive. So 3,000 contracts at 0.5 in this situation would be something that I would think would kind of create a liquidity vacuum and make it difficult for them to continue moving up. But that's pretty aggressive. And I am kind of getting some signs of a meta order going along in the 5-year. So that might be something worth paying attention to. If I had been stalking along, that might perk my interest. That might be like, well, I don't know if I want 0.5, but if I'm stalking along, now I can say anything below 0.5 is probably okay. That's a large order where you like rotate around that. So if I can buy below that, that's good. Anyways, but you get what I'm saying? Like once you understand like the actual real nature of the market, and this is like that it's inelastic, and this is like something that has a lot of empirical data to back it up. If you want to get into that, go and look up Inelastic Market by Gabiax and Koijen. Was published in 2020, I believe. That they kind of show their evidence that the market is inelastic. So when you realize the market is inelastic and like every order has an impact, right? Then the whole premise of technical analysis, at least on an intraday time period, is just kind of silly. That like the move that happened last time tells you absolutely nothing about the orders that are going to come behind you. On average, they just don't, because somebody could be coming in for that has absolutely nothing to do with any of the stuff that came before it, right? But what I can do is it does tell me what's going on right now. It does tell me what's going on right now. And if I think that what's going on right now is somebody's buying it up, right? Then, or if I think that what's going to happen is somebody's buying it up, then I can look at what's going on right now and I can say, is there evidence that's supportive of my theory that somebody's going to buy it up? Now I can trade it. Gabiax and Koijen. Here, let me find it for you. There you go. It's on the National Bureau of Economic Research. Now, this is the paper that I would read. There's also one by Bouchot. Here is a microstructural interpretation. And what Jean-Philippe does in this paper is he goes through all of the things that we know about market microstructure and shows how those things directly lead to this inelastic market that Gabiax and Koijen are seeing. Basically, he's saying the reason the market is inelastic is because of the market microstructure. And he shows how, you take the equations that you get from market microstructure and then you just kind of translate them over to the application that Gabiax and Koijen are, and it explains the data that you're getting over there. So it's really good. I think it's pretty... I mean, listen, it's always a hypothesis sort of a thing, because it's like, here's the idea and here's the data that we have supporting it. And usually when a hypothesis is invalidated, it's not that because there was real empirical evidence behind it, right? It's just that we get like a better explanation, right? So when the inelastic market hypothesis is invalidated, it won't be invalidated completely. It's just that our understanding of it will become even more refined, right? But that is, in my opinion, like the most recent enlightening kind of research that we have. And once you understand that research, I think that it really kind of says that, especially for day trading, I think it explains why day trading is so hard and kind of changes how you're going to have to approach day trading. From, in my opinion, as a retail trader, if you can either be first in the queue or know what's going on. And if you don't know what's going on and you're not at the front of the queue, there's no reason for you to trade. That's my take. That's why I focus primarily on informational inefficiency, right? Like today, we know there's NVIDIA earnings, but we also know that we're in a seasonally weak time of year, that we had a lot of gamma expire last week. There's all of these sorts of things. I think there's a couple of other points. I don't know what buybacks are at. I think that most companies are back into being able to buy back stocks, though. So that one's a mark against us. But I would say that at least in the short term, that the balance of flows is down. Well, it was good for 25 points in the S&P 500. We'll see. Maybe if the rest of the week, if it goes further. FOMC minutes. No, do we get FOMC minutes today? I didn't. Oh yeah, you're right. We do. Oh my gosh, I opened up the tab to look at that and it crashed. You're right. We do have FOMC meeting minutes today, so that's another big one. Well, I'm concerned. I would be concerned that the FOMC meeting minutes are a lot more hawkish than people realize. Good morning, crypto. Oh, the study on inflation that I mentioned? Yeah, sure. Although so that one's a little bit less of a study. I wouldn't call it a I guess I did say it was a study earlier, didn't I? But it's really more of a what would we say, like an editorial article with a lot of data in it is how I would describe it, actually. There it is. It's from the American Institute for Economic Research, which is a Republican think tank. Or is considered a Republican think tank, let's say. So that's kind of another big caveat where I wouldn't put it up as like research. But he goes through a lot of data and kind of shows how... you want me to read? You want me to go into this? I don't know if you guys really care. Okay, what are your thoughts on trading combines? Is it a scam? Well, I wouldn't consider it a scam. So to me, a scam means that there is some form of fraud involved. In other words, they are saying something to you or making a representation to you that is incorrect. Right? That's a scam. And from that perspective, the trading combines are not a scam because they do offer a service. The service that they offer you is the service that they say it is. Okay? So it's not a scam. But is it a worthwhile venture for most retail traders? I say no. First of all, day trading is really hard. And again, if you aren't informed, if you don't know like what's going to happen, then there's really no reason for you to trade. Okay. So that's just the way it is. Most people aren't going to have an edge. So most people are not going to pass the trading combine. Okay. There are a lot of people that have kind of figured out how to utilize risk to make short-term profits. So there are a lot of people out there that are, making money from combines and taking a little bit of money out, but then they blow the account because what they're doing is super risky and eventually the risks catch up with you and then you blow the account. So on net, yeah, it's not really worth it to you, in my opinion. And like, honestly, if you do know what's going on, if you really do have like a long-term profitable strategy way of doing things, why wouldn't you just trade your own account? We have these micro contracts now. Yeah, the commissions on them are a little bit higher, but if you've got a profitable strategy, that won't matter. And you just keep building it up until you have enough to trade the larger contracts and you size up. And you don't need the combine if you really have a profitable strategy. So to me, the trading combines don't really make much sense. What about for people who are just starting out? Well, so I think one of the arguments that they make is that trading in a program that has rules and things like that can help give a beginning trader structure. I disagree with that entirely. You can trade with your own rules. And quite frankly, I think that the rules that they impose on you kind of work against you. That it's a combination of you can't lose more than $500 a day. You can't have more than a $2,500 drawdown. And you have to make $3,000. And you have to pay again for every month. So people really, I mean, it can take as long as you want it to, but most people are trying to do it within a month or within 3 months. Okay. In order to reach those metrics, you have to be trading extremely aggressively. Essentially, the only way that you can do it is by taking on big risks that, just statistically have a certain percentage chance of coming around and blowing you up eventually. Right. So I think that if you start your trading, basically the biggest, well, I've already kind of talked about what is like the biggest misconception amongst traders, right? That the thing that they don't understand about the market that kind of prevents them from having success, right? And that is that they don't realize that the market is inelastic. Okay. But like I think that one of the biggest harms that have happened to retail traders has been everybody pinning the standard of performance to the combine metrics. I think that the combine metrics have led to a culture that encourages excessive risk taking and doesn't realize the amount of risk that they're actually taking on. Like, if you're just starting trading, guys, you can come in and you can trade micro treasury yield futures, right? Like literally an instrument that's $1 a tick on something that has maybe this whole session moved 10 ticks, right? So you're making or losing $10 at a time. So for the amount of money that you go in and spend on a combine, you can come in and start trading micro treasury yield futures for months and months and months. And getting experience from doing that and using your own money and being able to do things like a hold overnight and have a drawdown that's more than the 1,500 or whatever their metric is, right? I think it's a much better deal to trade your own money. When I started out, right, we didn't have MES. So if you wanted to trade the S&P 500, you just had to trade the full contract, right? And then we're talking about something that one move can lose $1,000, right? Most people can't afford that. And so it was like futures trading was out of reach for a large swath of people because the instruments were just sized too large. And in that environment, the combines made a lot of sense because then all of a sudden you could come in and trade the futures for $150 a month. But now that we have micro futures, it just doesn't make sense to me, and I do not understand the appeal of it. And I would encourage you to trade your own account. So there are zero benefits. Well, if you have a strategy, why aren't you backtesting it, right? Like, unless you're trying to do informed trading, and then it's still, I think that you're better off trading your own money. How much capital do you recommend to start with? So I think that if I was just starting out, the first thing is you do have to put some money into your platform. So like, let's say that you wanted to do what I'm doing and use Jigsaw. So Jigsaw is about $500 up front. And then the live trading license is $500 for a year. But if you're just starting out, you don't have to trade it live. So you could put off paying for the live trading license, the $50 a month, just not pay that yet, right? And just trade sim. And then some brokers have like minimum amounts. So like if you go to AMP Futures, I think that you can get in for $400 now, $500, something like that. So that would probably be like the minimum that you could get into the market with. So $1,000, 500 of it into your platform, 500 of it into your account, and then you would be able to trade that amount for a long time. And if anything, just trade sim but just use it to have live data, right? But I think that, like, even if I'm starting with a super small instrument like the micro treasury yield futures, that I would recommend having like $1,000, $1,500, $2,000 to start. So, and if you put $1,000 into an account and trade micro treasury futures, you can trade for several years before you have to put more money into it. Were you profitable when starting out with ES and having all the pressure of high leverage? Well, I started out on what happened was I started out on treasuries. Then when MES came along, I switched over to that because I knew that it was going to be the hot thing. But then I gave up on that. Because when I was doing it with ES, I had some periods that were pretty good. But I never really got what I wanted out of it, you know? And I just came to the conclusion that equity indexes are way more random than other instruments. And so if the primary edge that I can actually pull out as a retail trader is being informed, then equity indexes isn't really the place to do it, except for on certain super big macroeconomic moves. So make ES thick again. I would love to see that. Yeah. I would love to see them reduce the point value of ES by a quarter. You know? Okay, what about commissions? Well, so for micro treasury yield futures, you pay about $1 in commissions. But for something that most trades you're going to make $10 on, that's not a big deal. I think retail traders like worry way too much about commissions, because the people that are, you know, that they're talking to at that time, that's their primary thing, right? Because the people you're talking to primarily at that time are what? The introducing brokers. So the main thing that the introducing brokers can do is they can charge cheap commissions and they can have good support. And that's basically the difference between introducing brokers for the most part. So of course they focus on the commissions, right? But the reality is that it's a very narrow set of strategies that, like, the commission is going to be the difference between you making money and not, right? A strategy that is really profitable will still be profitable even with slightly high commissions. And then as you size up, your commissions will go down. So that's a problem that fixes itself. The advantage might be a professional environment and maybe some group work. Maybe if you were like in the same room with other people. But to be honest, with the things that I've been hearing about these combines, they've basically been taken over by the Smart Money Concepts crowd. And so any of the stuff that you would be learning from the other traders in the combines is just degenerate stuff and incorrect things. Yeah, at least the CME membership. There you go. There you go. That reminds me of that that we're going to have like bond index futures coming soon. So on the CME, you will really have futures contracts for like the full array of the fixed income market. And I'm really interested to see how those are going to be priced. Degenerate stuff, yeah. You've got to understand that that basically everybody, just assume. Okay, so here's my metric, okay? 5 years, profitable. You're only intraday trading. You're profitable all 5 of those years, okay? I don't meet that qualification, by the way, okay? And I've never met somebody that does. Never seen it. They almost certainly exist, but I've never met them. And almost all of these people that you talk to that claim to be profitable traders, you will find that they've only been profitable traders for like 2 or 3 years. Okay. What happens is they're coming in and they're taking big risks. So I can come in and I can say, I only want to make 1 tick. And I will let it come all the way back here. Like, you know, it'll have to break the low. So I'm buying 0.5. In order to make a profit, it has to clear 0.2. In order for me to stop out, it has to break a new low, right? Okay, well, with those kinds of risk parameters, you're going to win like 90% of the time. Just if the market was Gaussian, you would win 90% of the time, right? And so what these guys do is they will find market periods where you're unlikely to get like some massive trend coming against you, and then just take those kinds of skewed risk trades. Okay, so they think that it's because of their setup and all of these technical analysis things that it's more likely to go up than to go down, and yada yada yada, and that's how they get their trade. But really, where their profits are coming from is taking on risk. They're taking risks in relatively low risk market environments that really skew a certain way, okay? And the reason why these kinds of risks are there and available for you to take, right, is because there is a certain risk of things going wrong. It's just it usually doesn't happen, right? 90% of the time, the bad thing doesn't happen, okay? But people are paying for you to take on that risk because they know that when the bad thing does happen, they're completely screwed, right? And so that's kind of what happens, is these guys, they come in, they're making money from taking on risk. We call it risk premia. Okay, they're running a risk premia strategy, and then when like market volatility comes along, their account gets wiped. Is what happens. So there are strategies that are not net profitable, but you have to have a lot of data to see it. They have fat tails, and you need thousands of trades before you see the tails. You ever read the rules for market makers at the CME? It's a many 100-page book. I did not understand. Oh no, I've never heard of such a thing. And when I search for that, I don't get anything. Industry filings, designated contract market rules. So any kind of risk strategy will be unprofitable long term. So not necessarily, but I would say that by and large they are unprofitable. And the bigger issue here is that they don't know, right? They're not sophisticated enough to understand the statistics of this. Like, they're coming in and they're like, oh, I made money this month, or I made money this year, and so now I am forever and always a profitable trader. And they don't know the statistics of their own strategy. They don't know that over a 5-year time period that this strategy was actually negative, right? And so then they turn around and they teach it to other people, and it's nonsense. And I know these things because I can backtest them, right? So like I have a video where I backtested a smart money concept strategy, and I kind of showed why it didn't work. In fact, on that one, from what I can see, it was profitable for a time, primarily because it became so popular among retail traders and that it doesn't work anymore. That it got too popular, and now it's a way that people get hunted. So, right? But what happens is, oh, I made money this year. That must mean I'm profitable. So then those people, they go out and they start sharing that information. They start posting on Reddit. They start a YouTube channel or whatever the deal is. And then everybody else goes, well, he was profitable for a year, so he must know what he's talking about, right? Meanwhile, you got people like me telling you the truth and saying like, look, here's the actual data. Don't trust don't just trust what somebody says. Like, actually have empirical evidence and do all of the science behind it to see how these things work. And then you'll see that over a sufficiently large data set, it doesn't work the way that these people say it does, right? But that's not very encouraging. I was like, oh, well, maybe I shouldn't day trade. I'm sure I probably talked a lot of people out of day trading, right? And so their followers leave the market and it never becomes a big thing, right? And that's how you end up with the majority opinions in the retail trading community end up being falsehoods that misunderstand the fat-tailed nature of the market. You ever? I haven't day traded crypto, but you know, I've actually made a couple $1,000s off of cryptocurrencies, and kind of just I got so sick of that market that I was like, well, I probably should be buying right now, but I just don't want to be involved. So I have stepped out, let's say, of this current market cycle. I think that Bitcoin might have a little bit more to run this year too. They'll probably decline with the rest of the markets if we get a little bit of softness here, but overall, it looks like there's inflows coming into Bitcoin because of the ETFs, and that will probably push the price up. Okay, so how do you gauge the amount of risk that you are willing to take per trade? That's a good question. So first of all, you want to do it from like a dollar perspective, right? You want to say, I'm willing to risk this many dollars, right? And the way that I do it, because you do want to take risk, that's kind of the interesting thing, is that if you have a real edge and then you add the risk premium on top of it, that's when you get really good trades that can really bring in money. So you do want to take risk, but you have to be sure that the underlying edge that you're trading is actually an edge first, right? From there, how much risk should you take per trade? Well, when you kind of go through the statistics and things like that, here's what I would say. And I wish I knew how to derive this for you, but I can just tell you from experience and doing a lot of back tests and stuff. Like, you want your account to be able to handle taking your max loss 20 times in a row, right? You want your account to be able to handle taking your max loss 20 times in a row. So like, if your max loss on a trade is $100, then you need to have at least $2,000, right? Plus whatever the margin that you would need for the number of contracts that you're going to trade. See what I mean? Do you notice markets make a permanent shift in 2020? Well, I wouldn't say a permanent shift. The market's definitely changed in 2020. I think that a lot of the things that changed have kind of reverted back to the way that they were before, though. Like, market volatility has come down, and we've turned back into a market where you sell market volatility. Well, the biggest shift was the change in liquidity, right? For risk, wouldn't you be using sorry, I can't read that word. Oh, a percentage-based approach versus a dollar amount. So not in futures. Yeah, so for if you're trading stocks, then probably you want to do something like that, right? Like, adjust the number of contracts or the number of shares that you're buying for, right? But in futures, that you can't take quite that same approach, especially if you're a small account, right? If you're a small account, basically the percentage, like 1% of your account or whatever the deal is, right? You're going to know what that number is in dollars, right? And if you make a winning trade, it's going to be the same tomorrow. Like, you're going to have to make a ton before you would have 2 contracts, right? So the percentage that you're actually taking is not going to be what you want it to be in futures. So you kind of can't take that approach. But what I'm saying instead is, understand what your maximum drawdown is likely to be, and then ensure that you have an account that will be able to survive that. And what I have found is that with almost any strategy, even the ones that are like high win rate strategies, there's a good chance that you will get 10 losers in a row, if not 20 losers in a row. So if you can handle 20 losers in a row, then you're probably okay. Even watching Jigsaw videos from like 5 years ago looks and flows very different. Yeah. Well, so yeah, there was this thing like the biggest change was the liquidity. The treasuries over the last 2 months seem to have recovered their liquidity. So we're back to putting 3,000 contracts up. There was a period just before the pandemic where the treasuries were putting like 5,000 contracts at every price. Okay, but that was unusually thick. When the pandemic hit, all of the kind of basis trade strategies out there, these are people that they buy the bonds and then they sell the futures against them and pocket the difference when they deliver the bonds. Those all blew up like all at the same time when the Federal Reserve was like emergency reducing rates and things like that. So the treasury market just shot up like super crazy really fast, right? And when that happened, all of the liquidity disappeared. So we went from putting up 4,000 contracts at a price to only not even being able to put up 1,500. And so that was a big change. Meanwhile, over in the S&P 500, they were like hitting circuit breakers every day and stuff, which was really crazy. And I've at the time I thought, oh, this is just silly, because I didn't think that the situation really justified the amount of market volatility that we were getting. I think that was probably incorrect in retrospect, but at the time I thought it was crazy. And then what happened was after that, the stock market went on this insane run and they pushed all the way up to, above 4,000. And so now all of a sudden, the S&P 500 was like up 25% or something like that. It was high enough that the numbers didn't make sense anymore. So, when I first started trading, it was not uncommon to see 800 contracts at a price, right? On my DOM right now, I am aggregating every 4 ticks. So I'm aggregating every 4 ticks, and even with 4 ticks together, they can't get over 500 a lot of the time, right? So, yeah, the liquidity changed. The S&P 500 moves a lot more wildly these days because of that. Is there zero edge in technical analysis, statistically speaking? Well, so that just goes back to the conversation we were having a little bit earlier about depends on what your definition of technical analysis is. But I would say that quantitative analysis can work. Okay, you can come in and look at market data. I think that the more kinds of market data that you look at, the better. So if all you're looking at is a 1 minute chart, probably not going to find something. But when you have the order flow and you have, sentiment indicators and things about the valuations of companies and all of this other data that you can crunch together, you can pull together something that, statistically speaking, does have an edge. Yes. But the thing that you got to understand again is the market is very inelastic. Every order has an impact, and the impact of those orders are way stronger than we think. So even a mildly large trader can come in and move the market and break your trade, right? So the problem is not necessarily the technical analysis, but that's why what I define as technical analysis is the trades the strategies that are taught by retail traders that are quantitative in nature, right? That's the actual problem, right? Because if you're coming in, you're only looking at one data series, that sort of a thing, there could be a statistical edge in it, but then you start trading it, you're going to have that impact. You wash that trade out. And so it removes those strategies very, very easily from the market, right? That means that if there is some kind of statistical edge left in the market, it's going to be hard to find. So the more sophisticated your analysis is, the more likely you are to find one. It would be lovely if you could find one that's really simple, but those usually don't exist anymore. You get what I mean? Two contracts buy, market sits still. You buy one contract, market drops 8 ticks. Sure seems like that sometimes, doesn't it? But if you ever become a successful trader and you size up and you're trading millions of dollars, you will learn very quickly how inelastic the market is. That's usually the first thing that kills people that get big. What do you think of the current equities market now that we have pension funds buying tech stocks by leveraging? Is quite worrying. Well, I do think that the market is probably in a bubble right now. I don't think that the valuations really make sense. I think that on one hand, I think that the market is underestimating the interest rates. I don't think that they're going to cut 3 times this year. Like at this point, I'm not even sure if they're going to cut even once this year. I think that that's kind of all wishful thinking. And I think that these things affect these stocks more than they realize. I think they've all kind of taken this tack like, well, it doesn't matter to Google and Amazon. But I think it actually does. I think that these companies, they've been shedding employees and stuff because, you know, the funding's not there. The debt is too expensive now. And then on top of all of that, we just had a lot of gamma expiring. This is a seasonally weak time period. I think that like February to March, this next month is very likely to be negative. I wouldn't say it's guaranteed to be negative, but I would say it's very likely to be negative, just looking at all of the things that we know driving the flows at this time. Now, pension funds leveraging in buying tech stocks, I don't know if that necessarily gives me more concern than anything, but you know, if we get a quote unquote pullback, would not surprise me to see the market pull back 20%. And there's a lot of analysts predicting that. So raising rates just before the election would be really bad. But you know what? I here's what I think is going to happen, because let's say from October to December time period, the whole argument in the political sphere was, hey, the economy is doing really, really good, but sentiment is not very good. So people aren't happy about the economy. What's with that? And the economy is like one of the biggest predictors of whether a politician is going to get reelected. So if we can figure out why people feel so bad about the economy and convince them that the economy is actually good, then that will improve Biden's favorability ratings. That was basically what they were saying. And the media did this huge push for it, right? And basically what has happened now coming, so then you had January and now we're in February. And like sentiment indicators are going up and a lot of economic indicators are going up. And so now what we're seeing is people do feel better about the economy. People are starting to become optimistic that we're going to have like a soft landing and the market is making new all-time highs, et cetera, et cetera, et cetera. But it's not affecting Joe Biden's favorability rating at all, right? So I think that a lot of people were kind of doing this wishful thinking like, well, the Federal Reserve needs to normalize interest rates. And when they do that, then it will help the economy, and that will give Joe Biden the best chance of getting reelected. Doesn't seem like that anymore, right? So I think that that's part of why reality is starting to sink in. It's like, yeah, no, we're not going to have 6 rate cuts this year. There's going to be 3. That's what the Federal Reserve thinks. And we're already starting to get data that kind of puts that into question. And if the Federal Reserve was forced to raise rates this year, I think that it would really hurt the market. Yes. Because the market is kind of premised on, this year's market has kind of been premised on the idea that they're going to cut. So it would hurt a lot of positions. Yeah, it's just not a year to be bearish, being a political year. It really is the case that the politics affect things. Like, it's so obvious to me when you go and you read the speeches from the different members of the Federal Reserve. Like, the people that are Democrats are saying different things from the people that are Republicans. And it's so much clearer now than it normally is. I think that they're trying their hardest to be neutral and to make the choices that are appropriate for the current economy. And I have full confidence that they'll make the right choices. Or, well, I mean, generally they'll do an okay job. Let's say they're always going to make mistakes, right? That's the whole thing with a discretionary system like that. You can make mistakes, but you can't say that they're not biased. They absolutely have biases. Seems you've been streaming for a long time. You're telling me you haven't had any. Well, so when I say 5 years, yeah, I've never met somebody that had 5 years under their belt. We have a lot of really good traders in here and some people that have made pretty impressive sums of money, and people that have been doing it way longer than me even. But somebody that has 5 years in a row profitability, I have not seen that, no. What's your favorite way to get market news quickly and accurately? Well, I use Financial Juice. So you can see over here, that's just what I always have running on my other screen. I have Financial Juice Pro. They have like a lifetime subscription. So I paid for the lifetime subscription at the very beginning. Well, not at the very beginning of Financial Juice. And I've just been using it ever since. And that's how I get my market news. Hasn't been, over the past few months though, it hasn't been as much of a news-driven market. When it was the Trump years, this kind of like informed trading worked really, really well. But recently there hasn't been as much market moving news and whatever. Yeah, getting 5 years straight is tough. Yeah. I have run across somebody on Reddit that claimed to be profitable for 3 years, but they didn't prove that. So I would bet you that there probably are a bunch of people that we could find that have 5 years of profitability trading stocks. But 5 years profitability day trading futures, I bet you that there's a handful of them and they're not on the internet. But like, I don't know if we would have ever meet them. CL goes crazy with Israel news. Yeah, I guess that's true. That's true. I've done 3.5 trading. I've been profitable for nearly 5 years. But day trading stocks or swing trading stocks? That's another key. Kind of, from my understanding, you kind of more swing trade stocks, right? Yeah, not day trading. There you go. Exactly. So the question on that one then is if you take all of your swing trading in stocks, what is your performance relative to the S&P 500, and what is your Sharpe ratio relative to the S&P 500? So that means we should trade stocks? Well, yes and no. Okay, so how you should trade depends on a couple of different factors, okay? Number one is your personal financial situation, okay? The amount of capital that you have to risk, okay? Do you have a secure retirement, et cetera, et cetera, et cetera? Your risk tolerance, okay? And the actual edges that you have, right? So for instance, for me, I'm a programmer. I can come in and I can backtest things. So like a momentum strategy sort of a thing it was probably a really good place for me to go. Or high frequency trading would be a good place for me to go too, except for that I don't think that I'm willing to spend the money to be fast, right? But with my skills, I think that the place that I have the most advantage would be swing trading. Or sorry, momentum swings in futures. But for that strategy to work out, from what I understand, I need like $10 million. So I don't have $10 million. That's why I don't trade that, right? Okay. So for stocks, there's like the day trader rule, right? So if you really want to quote unquote day trade stocks, then you have to have a certain amount of money, and most middle class people just don't have that amount of money to risk, right? Like the number of people that they're fully contributing to their, they're meeting their employee match, they're fully funding their Roth IRA every year, and then they still have $20,000 left over after that. Not very many people that have that, right? That's why, we go for smaller things, essentially. You really shouldn't day trade. Anything is the ultimate point. It's a labor of love. It'll never be a job. Yeah, I don't want to say you shouldn't day trade. It's just there's a lot more in it than making money. Yeah. But like, again, it depends on like what you're trying to get out of it and what your goals are and so on and so forth, right? I would highly encourage people to manage a fund of some sort. Like, yeah, primarily you've got to, so let me like back up a little bit, okay? And let's talk about like the general investing things that everybody should know, okay? The tax man is a big deal, and the amount of money that comes out from taxes really has a significant impact on your returns. So much so that basically you will always make more money by putting the money into a tax advantaged account, which means your 401k, your IRA, Roth IRA, etc., etc., etc. Now 529s too, because you can. A 529 is an account specifically to save for your kids' like college, but they've changed it now so that if you don't use all of the money in the 529, you just roll it over into your Roth IRA. So it basically becomes a backdoor for you to contribute even more into your Roth IRA, which is super, super cool. And I think I would be taking advantage of that this year. But I digress. Okay, so the first one is your 401k, because most employers will have a 401k program. And if they have a 401k program, they probably do a match. So if you're not maxing out that employer contribution, that's just throwing money away. That's free money that they're going to give you to participate in that and doing something that you should be doing anyways. And then they're going to double your contributions. You cannot pass that up. That is money to be made right there, right? So the first thing is always max out your employer contribution to your 401k. And if you can't afford that, then you can't afford the current lifestyle that you have. Like, you need to downsize. You need to find ways to save more money so that you can do that. Okay. That's number one thing. And if I can give you an edge, because that's like the thing that everybody should know, but then there's the thing that I think everybody could know and would kind of give you a little bit of an edge over what everybody's supposed to know, is start early. Okay. If you can start doing that 401k, like you get a job at 19 that allows you to contribute to a 401k, and you do that your entire life, just from that alone, you will probably be able to retire. Okay. If you start like when you're 20. Okay. The later you start, the harder it's going to be. The next one is your IRA or a Roth IRA. So a Roth IRA basically allows you to make contributions post-tax. So you've already paid taxes. And then anything that you make in the Roth IRA account is tax-free. You don't have to pay taxes when you pull it out, which is super, super cool. Okay. And you can put $7,000 a year into your Roth IRA. Okay. Now, I would highly recommend doing that because you can use the money in the Roth IRA for certain things without taking a penalty. Normally, you can't take it out until you're 65 or whatever, right? But you can use it for as a first-time home buyer. You can use it to pay for college education. You can use it to pay for medical expenses. Okay, so contribute to your IRA. Okay. Now, the conventional wisdom after that is that once you've maxed out your IRA, then you should work on maxing out your 401k. And this is where I diverge a little bit. Like, yes, that totally makes sense. Okay. You will make more if you max out the 401k. But at that point, what you should be doing is you should be saying, okay, how much am I actually saving a year? How much am I going to have to spend on college? So you can go and look at the university in your area and say how much per year is it going to be for my kids and how much do I have to save up for them, right? And then after looking at all of that, say, am I actually covered for retirement? Like, am I on track that I will be able to maintain my lifestyle into retirement, right? And if you are at that point, then you don't necessarily have to contribute more to your 401k, right? Because all of that money that you're putting in there at that point is then overfunding your retirement. So at that point, that's where you want to start to do the analysis of, can I take risks? Can I take risks? And that's when then you take that extra money that you have and you can buy a property, you can start your own business, or you can start stocks. Okay. And I think that it's a very, very good thing for people to try and manage a stock portfolio. That is, pick 5 different industries that you think have a good mix so that they will do well in all market environments. And then from each one of those sectors, pick which company you think is the best, right? And manage a portfolio of 5 to 10 stocks, okay? It doesn't necessarily have to be a huge portfolio, okay? And you might underperform the market with it, okay? There's a chance, if you catch a 20-bagger, one of those stocks is going to pop up and can make you rich. One of those can pop off and make you risk. And the worst case scenario is you don't make as much as you would have made if you had put it in your 401k, right? But the things that you learn about the world, about businesses, from doing that exercise are invaluable. There's this whole thing like most when people become have generational wealth, it's usually lost within 3 generations. Well, the reason for that is because, well, number one, a lot of people get rich just because they're lucky. But number 2 is that you are very much a product of your experiences. And so it was all of the struggle and all of the things that you had to learn to do to be able to get that generational wealth, right? That made you be able to make that money. And if you then turn around and you give your kids an easy life, all they have to do is study and go to school and just kind of coast by, then they're not going to have those skills. And then they're not going to be able to keep the wealth in the family, right? And where do you get those skills? You do it from struggling. You do it from trying to start your own business. You do it from, working menial jobs at the very beginning and working your way up the job ladder. You do that by investing in trying to manage the money yourself. Because if you are constantly doing all of the research and reading for how to invest in stocks, right, then you're going to hear about these other things that I'm talking about, like that you should max out your employer 401k contribution. You should put the money in the IRA, right? Because what'll happen, and what I see happen a lot, is you have these rich kids, right? Their parents are super wealthy, they're millionaires, and then they're a kid, and then like grandma dies or something like that, and all of a sudden you got $30,000 to work with, right? And what do you do with it? And you go and you buy a car or something like that, right? Like they don't know that, oh, okay, well, I can put 7,000 of it into my IRA, and I can put another 7,000 of it into a 529 for each of my kids, and I know that I'm going to have to pay for college for each of my kids, so let's do that now. That's, and when is it worth it to me to put that extra away versus put it into just a stock index, or versus putting it into my stock portfolio? Like, what do I actually need? Doing all of that analysis, that's how you get to that point where you can keep that generational wealth. And a lot of parents just don't teach their kids those things or give them the opportunity to do those things, right? Okay, so then where does futures trading fit into that? Well, it frankly, it doesn't, right? Like, futures trading for most people is a net negative. You just lose money from doing it, generally speaking. Okay, but it's fun and you learn a lot from doing it, right? So you can justify putting a certain amount of capital into it, right? But that's going to depend on, do you have everything else squared away? Like, how on track are you, right? Because you don't necessarily, I'm not saying you can't trade futures unless you've fully funded your Roth IRA. Not saying that, but I am saying you need to go in and do the analysis and say, how on track am I for my retirement? And how much can I actually afford to risk in futures, right? Oh, Hintalag, how are you doing? Would your problem get fixed today if you only put it on a one-day chart? I really hope that it works, and if it doesn't, then I'm going to be like really frustrated. The seller seems to be a bit tired in the bond market. Yeah, well, I would say that except for in the 30-year over the last like 5 minutes, that overall the flows have maybe been slightly net positive, but for the most part, pretty constrained. Haven't seen actually a lot of activity. I wonder if the 20-year bond auction is not such a big deal, and the FOMC meeting minutes is a big deal, but that people aren't really willing to be taking risks ahead of it. I always recommend looking up the old MT4 virtual dealer plugin to understand how BS Forex and CFDs are. Yeah. Rather than saying to myself, I have zero chance to be successful, I say I'm not going to be part of the 75%. I don't know how to put it that way. Like, it's one of the things that I've been thinking about lately is I would say I've been pretty successful in my life. It's something that I'm constantly trying to help my family understand, because I don't think that they get it. They look at it as like, well, I don't have this and I don't have this. Well, I don't have a Porsche, so that must mean I'm poor. Well, no, it's just the reason that your life is so good is because your dad is somebody that's not willing to waste a lot of money on something like that. Maybe I'll buy a Porsche someday, maybe. But probably I would never buy a Land Rover. Okay, that's a better example. I would never buy a Land Rover. Such a waste of money. Oh my gosh. Ugh. You only own it for like 5 years and then you get rid of it. Waste of resources. I would never do that, right? But I make more money than like 90% of people. And why did I do that? So how was I able to do that? Because when I look back on it, I can see at least 2 situations where I could have become extremely wealthy and didn't, and I just kind of missed it. I passed on the opportunities, essentially. One of them was, I owned a home and I was renting out 2 of those rooms, and I had a big wad of cash. I could have gone out and bought another property and started renting that property out. And I probably would have become a millionaire from that, because that was the time when, like, just before, that was like 2016, right? So that was like just before everything really started getting crazy. And all of these people like, what's this bucket? Graham Stephan, for instance, became so rich from doing real estate stuff, right? So I could have done that, but I chose to get married and take care of my stepkids instead, right? That was the first one. Another one was, I had a pretty okay YouTube channel going, and then Fortnite became a thing, and I was kind of positioned to be like a top Fortnite content creator, and I just didn't care about the game, so I didn't do anything with it. I probably could have done okay with Fortnite. You know, there's so many places where I could have become, and the thing is when I really look at it, it was going to happen one way or another, just because I work so hard and I create so many opportunities for myself, you know. But how did I actually, you know, get to the point where I make more than like 90% of people? Well, I think that what it really came down to was my dad was a computer salesman. And so even back in 1988, when I was 3 years old, I had a Pentium 8088 computer, and knew how to use the word processor and knew how to use the DOS command line, and was interested in that from the very beginning. And that ended up being something very, very valuable, even in this current environment, you know, because robots are coming in and a lot of tech people are being let go. But guess who keeps the robots running? Yeah, that's me. Right. And that's how I made it. So there was privilege involved, essentially, right? There was privilege involved. I knew the things that I needed to know for the future that a lot of people didn't know. But it was going to happen one way or another. And that's something that I find kind of odd about that. I forget what comment it was that got me onto that rant, but saying, yeah, I want a 911. I would maybe consider getting one of the Porsche SUVs. I don't know. I'm kind of leaning towards not. I think that if I get a nice car, that it will be a Lexus, which is still in the same kind of price range, but I don't really want to spend a whole lot on a car, though. I don't drive very often, so I don't know if it's really worth it to me to spend a lot on a car, you know? But to me, there's kind of like a limit. It's like, I can spend, I could maybe justify spending $80,000 on a car if I use it, but not more than that. More than that, I think is wasteful, right? To me, it depends more on, am I actually getting value out of it, right? Like, is the value that I get out of the comfort of the car, you know, and that helps me be in a better state overall and all of these other things, then it's worth it, right? Like, if I still had to commute every day, then maybe it would definitely be worth it. But otherwise, I'd probably just get another, or not another, but a Corolla or a budget luxury car. Has to have a good sound system. That having a good sound system is very important to my quality of life. Get a BMW, not a Toyota. So I read this. I heard this guy talking the other day. He was saying that both BMWs and Toyotas are extremely reliable, but the difference is that in order for the BMW to be reliable, you have to catch all of the maintenance, and the maintenance is expensive, right? And that's the difference between them. I thought that was really interesting. That with the Toyota, they expect you to not take care of it, and it still works. Get a 4Runner. I've been thinking of a 4Runner, man. There's this. So I was at the car dealership last Thursday or something like that, because we had to take the car in for like oil change and tire rotation and whatnot, and we have a deal with the dealership to do that. So I was looking around at the Toyota dealership, And they had this Forerunner there that I really liked. So they didn't have it set up so that it was high, but they did have it set up with like the ladder going up the back, a good rack on the top, and then like lights on the front and the top. And it was white, and it was just kind of like that classic look. And I thought it was that classic look, but like a really new modern rendition of it. And I thought that looked really good. And I've been thinking my next car should really be focused on getting up the canyon to go skiing. So a car that's primarily for snow. So that really appealed to me. I don't know what happened with MT5, but I've seen a lot of people online all of a sudden talking about MT5 that like they can't use it anymore. That like a major broker went down or moved off the platform or something, and so a bunch of people that were using MT5 to do Forex trading aren't using it anymore, and they want to, which I think is funny because I think MT5 is the worst of the platforms. One of the prop firms. Well, the treasuries are selling here, man. I'm not seeing it in the flows in the 10-year, but I am seeing it in the flows in the 5 and the 30, but it's only just been this last 3 to 5 minutes. But we did breach at least the regular session lows. I think that for it to be a significant move in the 10-year... Oh, actually, I'd say it's a significant move in the 10-year. In the 30-year, they want to be below 0.8, so a few more ticks before it's, like, really significant. And yeah, I don't see myself buying a 911. Like, it appeals to me, but I don't think I could ever justify it to myself. I think the only way I see myself getting a really crazy car like that is if I thought that it would affect other people's opinions so much that it would open up business opportunities for me. But I'm of the opinion right now that the kind of person that I'm kind of looking to make relationships with, because I want to start a fund, isn't really going to be impressed by something like that, you know? So. Do you have any of the positions open? Well, so I still have this simulator swing short in the 10-year treasury. At one point, it was over $1,000, but it's pulled back significantly over the past, like, 2 days. Get a Wraith? Is that a car? Oh, that's a Rolls Royce. Gotcha. I'm doing pretty good, but I'm not doing good enough to get a Rolls Royce. No. So anything I can do anymore? So you're still having problems? Still tested with 1 day loaded, and it still doesn't load. And when it doesn't load, do you get errors in the output window? And the other indicators do load. We're waiting for first time seeing it yet. It's so weird because you're like literally the only person. Well, I've had a couple of people that didn't understand that you kind of need to put it on. It's best to put it on a minute chart, and with, you know, the main chart being a Forex future. But other than that, I've never had anybody have any problems with the indicator. So. I would think, though, if it's not drawing anything at all, that there is an error, and you should see an error in the output window. But I still kind of suspect that it could be that, like, your session templates are wrong. Like, maybe you could do this. You go to Tools, what is it? Database Management. Right? And then you've got Update Instruments, General Properties, Future Expiries, Symbol Mappings, Remove User Added Instruments. Click all of those and update. And then there's these like trading hour templates. And update that. That's the next thing that I would try. How do you determine how much an asset is worth? I don't. I don't. Wow, this is starting to move down a little bit more aggressively. Am I missing something? Still got 30 minutes left. Emerging markets debt to GDP ratio hits record high in 2023, driven by increases in India, Argentina, and China, says the International or IIF. I forget what that stands for. I don't see anything else other than that in the past few minutes, but they did just extend 3 more ticks. So that was like a stop run of some sort right there. I guess that I could say that that's a stop run, and now we'll see. If it keeps going further, then we're really positive that it's some sort of a large meta order. I find it a little odd that they waited until after 10 o'clock to make that move. But I was expecting them to net sell today, wasn't I? Okay, so anyways, I don't predict how much an asset is worth. I try to predict what the future orders will be. And that's true whether I'm trying to do day trading or I'm trying to invest in a company for 10 years, right? I'm sitting and I'm thinking, okay, what is it about this company that makes me think that more people are going to be interested in buying it in the future compared to other stocks, right? And especially if I can quantify those things. And then that's kind of how I look at it. Because if you look at an asset like NVIDIA, or probably even better example would be Tesla. I just don't see how anybody can possibly justify a valuation for Tesla. Like, all of the attempts that I've seen are just farcical. I think the reality of it is that the market tries to be efficient and quote unquote price things, and there are certainly models that can be useful, but that's not what determines the price. What determines the price is people buying and selling, the interaction between market buyers and limit buyers, market orders and limit orders, right? The dynamics between the demand and the liquidity supply. That's what moves things, right? Value does not equal price. There you go. So, while I might look at measures of value and different analyst expectations and things like that, I ultimately, that's not what makes me decide to buy or sell something, right? Error calling on state changed method. Okay, so I think what you need to do is jump on Discord and message me after the stream. What I probably need to be, so I usually do like a stand up and then I might have some time. But if you message me and then I'll message you back when I'm free, and we could maybe do a screen share. If you had Visual Studio installed, oh, actually, I don't think that would work either. Okay, maybe I can create a safe version. I can create a version for you that will output some debugging information for me. Because the question is, so it says index was outside the bounds of the array. I have to be able to tell where that's happening. How do you know if you're buying something cheap or overpaying for it? I wouldn't necessarily worry about that. I mean, so if the price earnings growth ratio is low, then that usually means that you're buying something for cheap. But that doesn't necessarily mean that it's going to go up and that it's going to be a good trade for you, right? On the other hand, there are plenty of assets out there that are like crazy overvalued, and you still make insane amounts of money buying them. So I wouldn't only look at how well something is valued. Do you trust the data provided by the company? Well, I would say that when you combine filings over multiple quarters with, you know, looking at analysts who are much more steeped in this sort of thing than myself, you can get a pretty good idea of where things are at. But companies can kind of pull little tricks on you to make like one individual quarter look good or bad. Yeah, click the books. The one company that added an extra zero recently. Yeah, I think I need to make a, so I don't put like debugging messages in my code, because I could come in and I could make something that says this is the line that is coming at, but I don't want most people to get that kind of output when they have an error. But in this case, I think I could maybe do that. It's kind of a weird setup, man. I think part of it must have something to do with, though, that you're in Europe, that like the session templates are like not matching up. Also, you said each indicator output. So do your other, like if you add Alice to a chart, does that one work? You know, it doesn't lie. Market data. Well, actually, market data lies too. That's what I've been saying, right? I mean, that. So there's kind of an underlying assumption when I'm telling you guys all of this, because I feel like I already established it earlier in the day, but look, the market is not efficient. So there is information that is publicly available today that is not correctly factored into stock prices. What's Alice? This is one of the indicators. It's just one that I know doesn't really have any kind of funky session stuff. So if you add that to a chart, you know, shouldn't even have to change those settings. It should just work. See? So if you add Alice to a chart and that one doesn't print out, then that would maybe tell us for sure that there's something screwed up with your templates. Yeah, Retro says I downloaded it yesterday and it works for you. Yeah, I tell you what, Pentaclag has a weird situation. He says that one works. This is a really perplexing problem. I think so one of the things that really is annoying about NinjaTrader is that when you get that, you know, Oh, wait. Error calling on state change method. I did not read that all the way. Hold up. Well, but I'm not necessarily talking about the future valuation. So I think that that's the ultimate flaw in the value method of investing. Is you come in and you say, okay, this thing is undervalued today. Okay, well, what makes you think that it will be correctly valued in the future? That's why I always say that it's like, I need to know something that like I think is not being factored in incorrectly by the market, but I also need something that will force the market to start valuing it all of a sudden. Do you pay attention to CME block trades? Probably not as much as I should. You use Newsquawk, formerly Randsquawk. They will notify you of those sometimes, and they can be good trades. So I'm wondering if I get rid of this one feature, because it says that it's doing it in error, on calling on state change method index was outside the bounds of the array. I can only see one situation where I don't have that. Or sorry, I only see one situation where I'm calling an index where that could potentially happen. Which is kind of weird that you would ever get into a state, though, that would happen now. But perhaps that's another one going back, like, make sure it's on a minute chart. Because maybe if you were on a range chart and it hadn't actually printed a bar, it might do something weird there. Because the indicator comes in and looks at some properties of the main data series. And the output that you're getting kind of suggests to me that it's having a problem grabbing that data. So maybe I can make a version of it that is disabled, where that is disabled for you to see if that changes it. The way I view investing without due diligence is important. I'm just saying valuation is one factor, and I wouldn't recommend making your choice based solely on the valuation. Because again, prices are not efficient. So if the current price today is incorrect, what makes us think that they will correctly value it tomorrow, or that the value will be higher, right? What really determines where it's going to go is the people buying and selling it. And if I have a reason that people are going to start buying it more, because it's undervalued now, like why is it undervalued now? Then that thing changes and now all of a sudden they're interested in it, right? And that's how you get those kinds of crazy trades. Well, or investments, let's say. Someone bought 35,000 2-year contracts and sold 14,500 in the ultra 10-year as a spread. How can you see that? That it was the same person that did both. But if they're buying the 2-year and they're selling the 10-year, then that's a steepener, right? CME website, huh? Well, so it's a steepener, right? They're buying this one and they're selling this one. Means steeper. It means my spread indicator is going to go up. Now, right now, the spread is flattening. So what that means is he's losing money right now is what that means. But it looks like that it's a 2 and 10-year spread. They're even doing it in the right, like 35,000 versus 14,500. That's 2 to 1. That's definitely a 2 and 10-year spread. And in fact, with the amounts that they're doing, I wouldn't even necessarily say that that's a huge trade. So. Yeah, you can't trust the company to be truthful on their current state of their business. Well, sure, but like, so for instance, is Tesla being forthright with us about the state of their business for the last like 5 years? I would say no, they haven't. Okay, what we're seeing today with like the Cybertruck being just like absolutely terrible. And them reducing the prices of all of their vehicles and stuff. I would say that they haven't been completely fair with us about the state of their business. But the stock still went up. And why did the stock go up? Well, because it's the most popular stock. This is what everybody's talking about. And so people buy it. The stock market machine is broken. It's not. It was always broken, Mohammed. It was this dream where like prices were a fair and accurate reflection of what a company or an asset was actually worth. It never actually existed. It's a fairy tale. That's what the market tries to do, but that's not what actually happens. And maybe one could argue that it's more broken than it usually is, but it has always been broken. Prices are not an accurate reflection of a company's value. Maybe over like a 3 to 5 year time period, then maybe you could say that prices are fairly efficient, but like 5 years is a long time for a valuation to come like back in line, right? Yeah, I don't put a whole lot of stock in the Wyckoff stuff. Don't see no empirical evidence behind any of that. But I think that one could argue that the market is less efficient than it has been in the past because a larger portion of the volume is uninformed now. Basically, like, so much of the volume is just index funds that's having like a huge impact on things. What do I got going on here? Oh, okay. I want to do the meeting earlier today. I will. Got to make sure to end the stream on time then. Wow. I'm trying to fix my amplifier right now. Blew up a row of high voltage side moffets without burning my vehicle down. I must be. So I don't know a whole lot about that stuff, but that sounds like that was something pretty crazy happened though. Like, wow. I think I missed some comments. I'm just gonna scroll back here because I was like, I think there was something else I was gonna say and I didn't say it. Bloomberg terminals seem like a cheat code. Heard you could see ads from big players wanting to buy or sell X amount of X. I'm not sure what you're talking about with there, but there's definitely some value to a Bloomberg terminal. You can definitely make more money with the Bloomberg terminal. Wait, this was one. Oh, I don't want to get into this, but I just was. Since things slowed down a little bit here, I was like, oh well, let's just take another look at Reddit, and I saw a post on Reddit that I'm like, what are they trying to say here? Oh my god. I was kind of thinking like crypto tick trader, what he was trying to get at. So it was like, we're really focused on, you can't trust a company to be truthful on the current state of their business. Okay, sure, but what does that have to do with, why were you bringing that up? Because that doesn't really address what I'm talking about at all. Okay, so what we would need to see for like evidence of Wyckoff's methods is we would need some sort of numerical statistical proof, right? Like I would have to say like Wyckoff says that well, how would we say that? I mean, the general idea behind Wyckoff is that there's manipulation in the stock. That like a stock will go down, and there's kind of these patterns that they do, and then it'll stop out, and then that's when it goes higher, sort of a thing, right? And he says this is because of stock manipulation, right? How do you prove that? Right. Once you start to think of it from a scientific endeavor, you kind of realize that like it's kind of saying something that you can't really prove unless you had a way to go in and look at like every order that was placed in that market and talk to the person that submitted it and see why they placed it. And then they would tell you, oh, well, I placed that because I was manipulating the stock to do this, right? And then we would go, oh, yes, okay. Wyckoff is a thing. Well, one thing that we could do is we could say, let's look for this pattern. And then when we see this pattern, does it tend to go up afterwards? And if we saw a large enough data set and whatever the thing is. But the problem is that like, if there was a pattern like that, it was so clear, people would pick up on it and then trade on it and change the pattern, right? Yeah, Wyckoff methods, they're based on, and you're right. You're absolutely right, Mohammed. They're not empirically backed. They are basically, this is what I think I know about the market. Based on what I think I know about the market, these are the conclusions that I can make. So they're using induction. And then they don't ever go back and say, okay, but that doesn't mean that it's true. Can I actually prove it? Do I have numbers? Do I have empirical evidence to back up what I think is happening? And the reality is that they don't. And I think the case with the smart money concepts in particular is that the thing that they're saying happens is just like a complete misunderstanding of how the market even works. Like, I don't think that these people understand the way that the book works. And I don't think that they understand the impact that orders have. Because once you understand that the impacts that orders have, then you kind of start to say, well, but how would you pull off that kind of manipulation that they're saying is happening? Because if you buy something, that is going to move it up. But then when you sell it, that's also going to move it down. So how do you work that out, right? The only kind of trick that you can do with this that I know of is if I own like 30K of something, let's say, I already own 30K and I want to buy more. And when I buy more, I want it to move up. What I could do is I could sell the 30K that I already have and then buy it all back really quickly and then buy more. And that could result in this kind of thing that will kind of swing the stock a little bit further than it would have if I had just started buying it from here. Right. So there's that. But that's like the extent of it. And how often that one's actually happening, I'm not sure. But that's just me looking at the inverse sine law is a thing and gaming out how you could potentially use it to your advantage. Well, there's another 4 ticks lower, man. I tell you what. It's a pretty good downtrend in the treasury. It's not that, I mean, we still got a ways to go before we're like at lows. But it is time for me to get going, guys. I'll just pull this one up. Right. Still a long ways to go before we're like, from 2 days ago. But we'll see where we get. We've got a lot of things happening today because we got the 20-year, well, not a lot of things, but 20-year auction and the FOMC meeting minutes. That could significantly shift the way the market is thinking, and NVIDIA earnings. So be careful out there, guys. I got to get going, so I will see you tomorrow. In the meantime, stay excellent.